Robschild. No investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Saturday, May 24th, 2025. Today's episode begins with our headline, Dr. Copper breaks out, pros stunned after S&P's 22% surge. Post-liberation tariff tantrum day happened. We had a surge in the S&P 500, believe it or not, from the very bottom to the very top of this move, 23% actually. Many professional traders and investors are absolutely stunned over this move. The sell-off was pretty dramatic on very high volume. Many people were dumping their stocks left and right as fast as they could. But once we had a rally coming back, volume really dried up. And at this point, I want to just emphasize how little amount of players actually control the price. Are you trading the S&P 500 in all your stocks every day? It's a very, very tiny percentage of people that actually control the price of anything on a day-to-day basis. It's an important thing to remember, just to emphasize the fact that this can easily go straight back down on Tuesday when markets open again, or we could be soaring higher. Nobody really knows for sure. All the pros are very confused. They're scratching their heads over what the heck is Mr. Market is doing here, including myself. The peak of this move on May 19th, Monday, even included Jamie Dimon warning that investors are showing extraordinary amount of complacency, citing especially potential credit risks. Something I've talked about for a long time on this show, how odd it is for credit spreads to be this tight where we are. And now with the tariffs being added to the equation, the credit risks are still not priced at all. There's no more risk in holding riskier credit, according to Mr. Market, at least for now. Me and everyone else has been watching Dr. Copper with a PhD in economics like a hawk after the tariff day meltdown and just this wobble into this coiling up pattern. We obviously saw Copper eventually breaking out, and he actually, believe it or not, broke out to the upside on Friday. Now, it's not to say that this can't reverse the other way quickly. This could even be short covering. This could be getting to a neutral position before, we let things settle into the next week after Memorial Day. Apparently, it's a normal thing for markets to get a little bit bullish around Memorial Day because people have time to look at their stuff and the institutions want it to look pretty, so they make everything look good. So this is one of the stories going around out there anyway, that we're kind of setting up a place for retailers to just jump in before the institutions flush the markets down again. But nobody really knows what's going to be happening here. For now, if we just go by Dr. Copper with a PhD in economics, he got bullish on Friday. And if this continues, it adds to our second headline of the day, which is just that markets currently, as they stand, as things are right now anyway, markets believe a little reflation. In other words, inflation coming back a little bit, not a ton again. I just want to add to, by the way, that, the tariff tantrum, we had the 10-year break-even inflation rate, the market that is the best place to look at where markets are really seeing inflation moving forward. But since then, we've been climbing higher and higher. We've been seeing higher highs and higher lows. But on Friday, again, cooling off a little bit. But overall, that pattern as well. We're seeing a little reflation and otherwise perfectly fine, supported by the price of the S&P 500, Bitcoin, Fartcoin, everything sort of seems fine. The bear case adds up to the fact that we have bubble-like valuations. Besides the dot-com bubble, which part of this has to do with earnings contraction as well. We haven't had earnings contraction yet. The Shiller PE ratio says that stocks have basically never been more expensive. This chart is a 150-year look at the way we usually price stocks, and stocks are extremely expensive right now. This is on top of housing being more expensive than ever before. This is on top of gold never being more expensive before compared to the price of everything else. We are in a massive bubble right now. So, that is a big piece of the bear case. Another piece of the bear case is we're post-yield curve inversion. We just went through. This is something I talk about on the show a lot, and I get sick of hearing myself say it at this point. But 2.5 years of yield curve inversion is nothing to be happy about. This signals potentially the worst depression that the world has ever seen coming very soon. Along with bubble-like valuations, we're setting ourselves up for something much more disastrous than I think anyone's ready for. But for now, markets are believing a little reflation, and otherwise perfectly fine. Besides the fact that consumers' sentiment is in the absolute toilet, anecdotal evidence from myself. This past, fiscal year, school year, or whatever, I've never worked more in my life. I've never made more money in my life, and I'm looking at the savings that I've been able to acquire this past year, and they're less than what they were the previous years. I know that I'm not the only one looking at my income and the prices of things and being like, what's going on here? Yeah, my sentiment's in the toilet too. And for people that make less money than me, it's got to be 10 times worse. But at the end of the day, the truth is that, markets can, and earnings can stay high, they can stay elevated until people actually pull the plug. It's one thing to be worrying about what you might have to spend money on or not spend money on, and it's another thing to make the decision, hey, you know what, I don't need a new iPhone this year. In fact, I'm looking at my financial situation, and I'm actually not going to buy an iPhone this year. People are still buying iPhone. People are still buying all the stuff that they normally buy for now. Forward earnings of companies are coming out less strong than previously, especially regarding tariffs. And right now, it's very probable people are buying stuff they think might go up in price, sort of trying to front run the tariff so they don't have to buy stuff when it gets more expensive. I think there is that going on. But until the fact happens, until people say, I don't need this remodeling of my house this year, it's too expensive, I don't need this, I don't need this, I don't need this because I don't have the money. Until people actually pull the plug on their spending, the music plays. The music keeps playing. And that's what the market sees happening moving forward. However right or wrong you want to see it, I don't think this is going to last very long at all. I don't even think it's going to last a week longer. But, I'm just a guy with a crystal ball. So what do I know? Anyway, moving on, community topics. What moves, if any, did you make on Friday? Robschild did nothing, just sat on my hands. Coming up, as always, continuous tariff updates. Recently got a hard 50% tariff on all of Europe because apparently they're not making any deals, and so the hammer on Europe, that's largely what was making stocks go down over the past, on Friday especially. Also, federal budget updates. Now that it passed the House and Trump is willing to sign it, it still has to pass through the Senate. And the new news on Friday with that is that the Senate is kind of like, no, we need this and this. One senator talked about, I don't want to see the debt ceiling raising higher. Another person said, hey, with his debt situation. Someone has to play dad in this situation and say, hey, look, we don't have the finances. We can't go to Disney World this year, guys. So there's some fiscal hawkishness going on for sure in the Senate. We'll see how that affects the votes and what happens moving forward. I sense they'll probably have to adjust the spending bill to make some more of the senators happy before it's all said and done, but we'll see what happens with that. Next week, we have Thursday GDP first revision. Remember, this was the first negative revision since, I think it was 2021. Anyway, it's been a few years since we've had a negative GDP report and this is for Q1 of 2025. And then, as always, the jobless claims on Thursday. I'm still gonna beat the drum and say one of these weeks we're gonna get a spike. Watch out, everybody. This is like the hard data that every economist, every trader is waiting for one of these Thursdays to see cracks in the labor market. When this goes up, better watch out. Anyway, we also have Friday the PCE data. This gives a lot. This is a very heavy weight item for the Federal Reserve. If this comes out blazing hot, you'll start seeing Fed funds futures start to price in the less possibility of hikes and maybe, cuts, and more possibility of maybe even some hikes coming in the near future. As always, thank you for watching, subscribing. The subscription button's right over here, commenting and supporting. I've received lots of support from you guys, and it's much appreciated. If you enjoy my 2 cents, support with your 2 cents, or in any other way you please. No changes right now, anyway, to the daily reminders macro views. I'm hoping this weekend to add the tariffs to this conversation, because I've been largely ignoring it, because I don't think the tariffs are even that big of the equation here, but it's an important piece that is going to affect the price of things and moving forward. So I'll have to add that in the near future. But anyway, the rest of this stuff still remains true. Click my website in the video description to read through my explanations of these very important things. No changes in the crystal ball ratings. I realized actually my long duration exposure is actually sitting at 57% of my portfolio now, with a large amount of it in TMF. And the rest of it in ZROZ. I don't actually have any TLT. It's just the one that everybody knows is the long duration Treasury bond fund that is more typical. I like ZROZ because it has added effective duration. Moving on to the charts, the S&P 500 did drop, and we are starting to form what looks to me to personally be more like a blow off top kind of formation than anything else. Much better chartists than me. I watch a lot of chartists to get their views. They're just mixed. The consensus that I'm getting from most chartists out there is that we're likely to revisit something like halfway down this whole bear train, so around, let's say, 5,400 level before actually going up to new all-time highs. That's sort of the expectation I'm hearing from most traders. But again, everyone's just scratching their head still, saying, like, really? Are we really doing this, Mr. Market? I guess we are for now. The fear gauge, the VIX, the pricing of options contracts, had quite a spike on Friday. This was mostly to do with the 50% tariff hard statement coming from President Trump. And with that, the VIX futures term structure, we're sort of inverted here. The front end of this being above, notably the November and December, all the way out to November and December of this year. So market's back on fire sort of right now. That's sort of why also I'm expecting this to definitely go down at least to here. I don't know where it's gonna go. It does look like it'll at least get down to here. I could see it personally continuing lower. Part of my reasoning, if you look back, for example, on SPY, when we went into the 2022 bear market, off of the, first major bottom in February of 2022, the markets went back up by 13% before finding lower lows and lower highs. The move of 23% to the upside is huge, but it also says that, we do have the potential to go straight back down the other way. If anything, I think too many traders and too many people are actually assuming a little too much bullishness right now with my own view of things and my crystal ball and my pet dragon Drakmar and everything. It's impossible to really say. With the S&P 500 selling off, TLT, actually my favorite place to be, actually got a bid going up 0.17%, not continuing to just go straight down anyway. One thing I feel necessary to share on my channel is something a lot of traders have been noticing and pointing out, is that we have this inverse head and shoulders on the, not just the 10-year yield, but the 20-year yield. I'll bring that up in a second. But we have it. It broke, but then it actually failed on Friday. We went back under the neckline, and so from a charting perspective, a failed pattern like that is typically like, no, this is over with. So I don't anticipate this playing out, and the 10-year is going to be the pattern that we should pay attention to more than the 20-year. But the 20-year has a very scary looking inverse head and shoulders. Again, this is just a chart pattern thing, but and also the 30-year bond yield, it has in very recent history made all sorts of these head and shoulders that have actually failed, that you would expect them to play out. We're more than anything just chopping around in this big channel, sort of the way that I see it still. But nonetheless, I think it is noteworthy to notice this pattern here of this inverse head and shoulder starting in November of 2023 with our left shoulder here, our head in September 2024, right shoulder bottoming April 2025. If this were to play out above this yellow line here, we would get to a yield of 6.1% on the 30-year Treasury bond, which would indicate a price on TLT dropping all the way down to around $70 to $71. Now, do I think that that's going to happen? No, I don't. And now that I'm looking at the chart, yeah, we didn't actually break the neckline yet. We were playing with it, breaking this neckline on Thursday, and got rejected down to the downside. We haven't had a close above this neckline yet, so it's a bit of tea leaves. And at the same time, with the reflation, with what markets are currently believing, I can't count it out of the realm of possibilities. I guess it can happen. I don't believe it would happen. If I did really believe it would happen, I would definitely be selling all of my Treasury bond exposure right now, and then buy in again when we get to 610 if it played out that way. But anyway, just wanted to put that in there, sort of devil's advocate against my own positioning. One thing supporting my idea that I really don't think bonds are going to be falling off of the edge of the earth is the MOVE index. This is the optionality of bonds, and it's been just going flat. If we were expected to have larger and larger moves in Treasury bonds, the MOVE index would be going like this. It would be going higher and higher and higher. We would see it above maybe April's highs. It's not. We're settling down here, just sort of waffling sideways. This is looking very calm. To reiterate Jamie Dimon's point that he made on Monday the 19th, when we look at HYG divided by SHI, credit spreads, it's probably better to look at the Fred, but point is we're back into this range as if there's no default risk. Nobody's going to go bankrupt. Everything's fine, says Mr. Market. Jamie Dimon himself says, yeah, this is like insanely complacent. This adds to the bear case of the stock market, the complacency of the credit market. It'd be one thing if credit spreads widened and stayed a little bit wider, just like getting comfortable with a little bit higher spread to treasuries. But that's not what's happening. We're going straight back in. We've been going straight back into absolute credit tightness. Might as well bring up the actual Fred chart here. We're back to the 3.3% zone, which is low. It's not worried about tariffs. Just take a look at from April 20th of 2022 all the way until 2024. Credit spreads were wider. We were in a range between 3.5 and peaking at almost 6 for that entire multi-year period. And right now, yeah, it's like it's close to no risk. And it's not as complacent as things were getting in January of 2025 and before that, where we were getting ridiculously tight in credit spreads. But we're still very, very tight, 3.3% right now. And when Jamie Dimon made his comment, it was even a little tighter. Interestingly, with the tariff news about Europe, Bitcoin actually dropped by 4% pretty quickly off of all-time highs. Whenever you get to all-time highs in something like Bitcoin, it's like any little thing can be like, okay, I've made my profit. I'm gonna get out. I don't know where it's going from here, but it was interesting. And then today's Saturday, 24-hour market, so we get to watch Bitcoin even over the weekend, recovering a little bit from that sell-off. Fart coin also went down. We're down on the day by 9%, but if we look over the past week, we're actually up 24%. So clearly one of the best investments out there, fart coin. Very intelligent investors are loading up on fart coin. I'm not smart enough to get involved with this, but clearly a lot of people are. And there's no way that they're being complacent here. Sorry for the sarcasm. I get emotional about these things sometimes. I try to keep things as calm as possible on Robschild if you've been watching the show and you know me. Anyway, moving on, wanted to take a look at the dollar index also dropping, but notably not finding new lows since April 21st, so sideways chop more than anything for now. I'm like the only person that out there that sees the dollar as not potentially falling off of a cliff here. If we do start seeing a major slowdown economically in the world, there often is a run to the dollar. So especially I'm thinking if we start seeing a run into treasuries, when people feel safer to buy treasuries again, perhaps we could see this really go way higher than anybody imagines. One of the markets that is not in agreement with this reflation idea is crude oil, not showing any kind of strength at all, still below $65 a barrel, still in a range of price not seen since 2021, guys. Crude oil is cheap right now. When crude oil goes down, yields are supposed to go down too. When you get divergences like this, people talk about crocodile jaws opening up, and it's just a matter of time before they shut. So either oil needs to just skyrocket or yields need to fall. That's what I see with my crystal ball. Gold, the price of gold went back up, and it's pretty clear that we are in this channel here, a descending channel after going up. This is pretty clearly a bull flag, And so it does look like gold may want to go higher here, despite the fact that gold is very clearly in a bubble in my very strong estimation, but there's enough gold bulls out there to keep this market going higher, I guess. Last chart of today, URA, uranium. Some people have been noting how on Friday we had a massive spike in the ETF URA. This holds Cameco and other companies that deal with uranium. I'm hearing professional traders talk about how this is like uranium going up, and I'm here to tell you that it is not. Uh, in fact, if you actually look at the price of uranium, we're seeing a double top here more than anything else. The price of uranium is not skyrocketing here. The spot price being only $71.55 on Friday, and this is not going higher and higher and higher. In fact, we're at the same price that we were back in January. And with URA, the ETF, approaching its all-time highs, uranium is much, much below its all-time highs. Its all-time high in this, well, not all-time high, but the high of the past 10 years anyway, getting up to $104 a pound. And yeah, we are only at 71.50 right now. So this divergence may set up an opportunity to, short URA maybe with some puts. There's no inverse fund to uranium right now. So if I caught this on Friday, I would have bought like one put or something like that. Anyway, that's all I have for you for today. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.